Hey, this is Drew Breneman. If you want to learn how to use your small axe to build an empire, you should be listening to the Small Axe Podcast with my good friend Nico.
Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys. Okay, Small Axe community, it's me, Nico, and I'm hanging out with a cool dude. So I met this guy, Drew, a couple months ago, and we hit it off. Why? Not only is he in real estate, but he's also got, comes from a family of teachers. His parents were teachers as well. And this guy's just really humble, really cool, and down to earth. And I'm excited to get him on to tell his story of how he went from a duplex to owning over 200 million in assets. So without further ado, Drew, join us.
Great. Happy to be here. Thanks, Nico.
I'm excited to have you, man. Let's go a little bit into your background. Let's tell the listeners a little bit about how you got to where you are today. Maybe take us on a little journey, and we'll kind of build and branch out from there.
Yeah, so I think, like you said, or I think maybe it was right before we turned it on, but both my parents were teachers. My dad was a shop teacher, and made a lot of furniture and enjoyed woodworking just like you. So definitely got that in common. But yeah, so started out really sort of in business, so to speak, just at the young age of like 14, 15 years old. I started selling things online on eBay. Buying and selling items in these video games that people were playing, like Diablo 2, EverQuest, and whatnot. Kept all the money from, saved it all from what I had earned during that, and wanted to learn about investing, and bought my first rental property when I was 19. I'm from Wisconsin, so I went to UW-Madison. So this is Madison, Wisconsin, and bought my first 4 deals when I was in college, and then got my first job up in Minnesota at an apartment development company. Met a coworker there. We pitched his dad on investing with us. So not like a childhood friend or anything, just someone that I had met once I was an adult. And he liked what we were talking about, buying, long-term rental properties, commercial properties, shopping centers, apartment buildings. And then the three of us, it's surreal to think that, to own a couple $100 million of property, but, I bought 2 million on my own, and then another, 100 million with that family up in Minnesota. And then, about 10 years later, met another family, similar scenario, bought another 100 million with them. And then today I'm really doing more just syndications. So I still invest with both those families, but the whole time over this, 15-year or so period, I had been invested in property. People were asking could they invest, and we weren't really set up to take on any other investors other than these two guys. So now we're set up for that, and if somebody wants to invest passively in multifamily, that's exclusively what we do today. So that's the quick version. So
Drew, that's awesome, man. I can't believe you bought a house at 19. I mean, most kids going to college are not thinking about that at all. They're thinking about partying, having fun. You, on the other hand, decided to get an investment property. What was that? Like, how come you decided to do that?
I've just always been like that. I just somehow am okay with delayed gratification and hard work. I still actually haven't really tapped into the money from those first deals. I sold one of them after owning it for 10 years, for example, and I did a 1031 exchange into 2 larger deals in Chicago. So I'm still, waiting to get paid from some of that, internet business money, I guess. Although I've made like a multiple on it now, obviously owning those deals for over 10 years. I just was interested in maximizing. I felt fortunate that I was able to make, it was between like $80,000 and $100,000. I never had an exact accounting of it, but, from that internet, from 4 years of doing it. So it wasn't a ton of money in any given year. And if you're an adult, that's not a lot of money, making, like 20, 25 grand a year. But, I felt fortunate I was able to save that up. I mean, a lot of people, it takes them a long time to save that up. then I started reading all these books about investing that usually you don't read till you're a lot older. And so I just, yeah, I was just sort of always been fine with it and putting in the work. So, I mean, I haven't been afraid of hard work. I just kind of, went through it quickly, but there was a period of time from 2009 to 2011. I mean, I legitimately was working 3 jobs where I had my own buildings that I owned and I managed those buildings. Then I was buying deals with this family. Plus I had a full-time job, and it wasn't like a 40-hour week full-time job. It was like a pretty significant commitment. So I was just working all the time. So, and it was, I liked it. I like investing in real estate. So it didn't really feel like a grind, even though it really was. So
That's intense, man. I mean, you like you really hustled, you really put your head down, you really got to work, and you mentioned the delayed gratification. I think that's one of like the biggest indicators of success, people that can put off and delay gratification. There was like a marshmallow test or something that they did, right? And they do it with kids all the time now, and they test them to see if they can have that delayed gratification because that's a huge indicator. Um, Great, man. So even that business that you were doing when you were younger, I mean, selling stuff online and eBay and hustling, that's you were serious with it. It wasn't like you were just kind of getting by. I mean, 25 grand a year is no joke, especially for a kid, you know. I'm impressed, man. All right, so you were working a full-time W-2, you mentioned, for like 2009 to 11. Are you not working that anymore?
no, I quit in 2011 and haven't looked back. So
What was that?
I worked full time at a real estate investment company. So I had invested all the money that I had made from the internet business, by the time I was done with college, and then figured, why don't I go get a job at some of these bigger places and learn what the big dogs are doing. So
Great idea, man. So you always have, well, besides the entrepreneurial spirit, it sounds like you gravitated towards real estate. Is there anything like in particular about real estate that you love?
yeah, I like it. I mean, how multifaceted it is. It's combines architecture and finance and law, and it's very interesting. And I've always liked real estate. Even when I was a child, we went to spring break somewhere by Tampa, and I never saw oceanfront houses before. And instead of like going and playing on the beach, I wanted my parents to drive me around and look at these houses on the ocean. So, just, yeah, always been like that. So, always sort of been in me, I guess.
That's cool, man. All right, so let's walk through a little bit of your deals. Maybe take us through a little bit of a journey of like 2000, I guess, 9 through today. What kind of deals were you doing? Was it always just multifamily? Did you have a certain target market or vintage? And what do you do?
Yeah, until recently, I was really always just buying primarily where I lived or one of the partners that lived. So in 2005 to 2007, those were duplexes and 3 units in Madison, and just all the deals, even starting then till now, it's been kind of similar where the rents were below market. I'm buying it based on the low rents because it's valued based on the income, and then I raise the rents, it's worth more, and then you could either choose to sell it for more or just hold it and cash flow it or refinance out some or all of the equity that you put in. So the early deals, yeah, were just $200,000, $300,000 deals, then a $700,000 one, and then once I had moved to Minnesota for the first full-time job and met that family, we stepped into some bigger deals where the first one we all bought together was a $2.6 million shopping center, a 2-tenant retail property. And then for the next 10 years, really everything I bought was between 1.5 and $8 million in terms of price point. And then it wasn't until recently that I started buying bigger deals, like 20 and $30 million ones. So
Did you syndicate the 20 and $30 million ones, or were you still using those families?
still using those families where, so one nice thing where if you have, the more solid your equity is, the more aggressively you can go after properties in terms of telling brokers or sellers, like, I know I can get this done. I have the money all lined up. So on a lot of these deals, the pitch was, I already have my equity lined up. I've already bought deals like this before. It's a sure thing for you guys. So, and 80% of the deals I bought have been off market or, off market through a broker, off market direct to the seller. But usually most of these deals, the size that I've been buying, they're pretty much always brokered. I know a lot of people, if you're doing single family stuff, like you can go direct to homeowner, but most of the people that own like larger multifamily or commercial deals, they want to sell through a broker. They believe they can get a higher price, or maybe that broker brought them the deal and they want to, um, you know, respect the relationship, sell it with them, involved somehow. So most of the deals have been, through a broker, but not fully widely marketed. Like these deals where they have a best and final bidding process and there's a couple rounds of bidding. I bought about 40 properties and only 2 of them were ever bought that way. So
Because if you're coming in with the capital, the equity already prepared and lined up, you have like the balance sheet to show and share, you have the credibility and the track record of closing like efficiently and quickly, let's say, you could just say, hey, we're coming in at asking price or maybe even a little less. And you know what? Brokers want a sure thing, and so do sellers. A sure thing, if it's not a sure thing, and it can be months and months at a time, and then it could fall out of contract, and then the property starts to deteriorate and there more issues arise. They want to get these things sold. So that's a great technique. Drew, can I ask you now, how did you begin to build those relationships with those families that you worked with? Because I'm sure listening, a lot of listeners are wondering how they can do it too.
yeah, and what's nice with kind of how I started out, where like it's something anybody could do. It's just I really put in a lot of work and developed skill and expertise in a given area. And so even, I would have met that first investor. I was probably like 22 or 23 years old only. But what they saw at that point would have been someone who already owns 4 rental properties and is working full time at a place where they're doing larger deals. We were, doing like $50 million apartment developments at the place I worked at. And then, they saw a lot of activity, and even already at a young age, like a bit of experience. So then I think, like I would recommend to someone, like you have to start somewhere. So I would, start, start as small as you need to. Buy a cheap house, or, FHA has that 3.5% down loan program on 1 to 4 units, start somewhere. And so then, how did I meet them? It was just telling my story where I had that activity. I told them, I just tell everyone I meet what I was up to. And at that point, I probably had told like 1,000 people. And now we're into the point where I've told this to thousands of people, I'm sure. The same story. And then it worked out where, 2 times out of the thousands, it worked out where someone's like, hey, we should talk to my dad or my father-in-law or so-and-so. And then that's how I landed those bigger investors. So it's a lot. You can't just be like, hey, I have an idea. I'd like to buy $30 million apartment buildings. We should try this. If you've never bought any deals, there's no experience there. Like you're going to need to show that you have expertise and that you have experience and that you have, activity in deals. So.
Yeah, excellent advice, Drew. Were those initial conversations or people that you met, like let's say that first 1,000, and that's that makes sense. I mean, 1,000 and you land 2 of them, you got to put in the work, right? How did you find those 1,000? Was it through networking on LinkedIn, Instagram, Facebook, or was it through networking events? Was it through podcasts? How did you kind of meet those first people?
Yeah, it would have been in 2000, this is 2008. So LinkedIn and podcasts weren't as big of a thing at that point. But I think it was really, just I was telling people that I was meeting in person. It was, so you go to school and I made it a point to tell everybody like what I'm invested in real estate, and just to kind of get the word out there. Maybe they could have been also they, as a college student, they could have been potential tenants, people I was telling that I bought this property there. Maybe their parents wanted to buy something. I just wasn't afraid to get the word out. So no, it was just, word of mouth, meeting people in person. So.
Yep. I love it, man. Good old fashioned networking. Now,
it's still the best way, just maybe to jump in again. It's the best way to do it in person where, sure, if you can have 1 million followers on Instagram, I'm sure that wouldn't hurt, but really you're still almost like a cold relationship, a cold lead for like a sales term. Whereas if this is like a friend of a friend, or now like the best sort of passive investor, in my opinion, we can get in our deals is someone who they're already an investor in our deal. And then they tell someone they know, like I invested with Drew. He said this would happen and then he delivered. why don't you should check this out. Like those people have the highest probability of investing, and also ask the least questions. Not that it's a problem to ask questions, but they just sort of almost on the referral alone are in if it's something they would be interested in.
Yeah, you're right. It's not a problem to ask questions, and people should ask questions. But then there's a fine line between the nagging investor that nobody really wants to take on, and that could be problematic, right? Because maybe they're too nitpicky with the way things go. And then I've had some great experiences, or actually all of my experiences with my investors have been great, where they're just so understanding. With the more transparent you can be with what's going on, they seem to be willing to accept and just roll with it and come along for the ride. So they trust in the operator. As you're talking, I thought of a question, Drew. Have you ever shared like a pitch deck or like a sample deal that you have done, or have you ever spoken numbers to potential investors when you're having these conversations?
Yeah, we actually were not making pitch decks. We are now because they're showing them to more people to invest, smaller chunks of money into. But no, we would usually just do a 10-year pro forma. So, here's the pro forma today, and then run it out 10 years and see what we would make if we on a 10-year hold. But that was just sending like a 2-tab spreadsheet to them. And then usually they were not looking at that too hard. They were looking at what's the cash on cash. And then, in the earlier ones, they're looking hard at them, let's say, but then a lot of them were similar to the last one. So it was like, hey, we found this apartment building. It's just like the one we bought 2 deals ago. So there wasn't much to talk about. It was like, here's the returns. And then, a lot of times the only question was, how much do we need to throw in? And, it's a 600 grand, it's $1 million. That sounds good.
That's awesome, man. Dude, you don't have to answer this question, but I'm going to ask it because I know people want me to ask this question, and I am here for my listeners. So, with the families, I don't know if they're family offices or whatever, but the investors that you had, what was like the split like? Are you doing everything? I guess you can give yourself a title. And was there like a split that you kept versus their equity?
Yeah, and this is a great question, because one thing that I think people do is overcomplicate this part of the equation. So, while it is most common to have in a deal like this, a preferred return, and then a split once it exceeds a certain hurdle rate and all that, and then the person doing the deal charging fees, that's all like pretty complicated. It's fine, and there's a reason for that. It's to align the incentives for outperformance above the hurdle rate or the preferred return. But this was just basically 3 guys talking, like, how do we want to set this up? And one negative with the like having a preferred return and then a incentive fee after that, or promote, or whatever term they want to use, is like it incentivizes the person running the deal to sell sooner because they want to get into their fee. Or if they hold it longer, then they go, well, most of the big pop in value was early on, so I want to sell and not have my share of the profits diluted. So I know this is like a long answer to get where I'm going, but where we were all fortunate in retrospect that we kept, and this was with both families, that we kept it extremely simple. I got 20% of the profits. And then the work of the the family was putting in the money of the investor, and then the son or son-in-law, both of them, they got a share as well, and then they work on the deal as well. My job was to source the deals, line up the debt. They lined up the equity, and then property manage it together and do work on a post closing. But we kept it really simple, where I didn't charge any fees. So also that's part of the reason why I kept my day job and my own properties, where we buy a building, I didn't get paid anything day one. If anything, I was spending money to go check out the property and just different just costs that I had myself, but I was getting 20% share of the profits of large deals. So in 2011, when I quit my job, I had a 20% share of the profits of $25 million of property. And I owned, at that point would have been like around $1 million of deals on my own. So then, so I would encourage people to like think creatively as well about how to set up the deals, not just always do the standard 6 to 8% preferred return, and, you know, whatever 80-20, 70-30 split kind of thing, because that works well for like a 3 to 5 year hold, let's say, in a lot of scenarios. I think that's set up. But if you're thinking, we don't know how long we're going to hold it, and it might be better just to be like, hey, let's charge less fees or no fees, and then have a more simple structure. And why I said we're fortunate to have done that is most of these deals we still all own together, and we've had like that first deal, the first shopping center we bought that in 2009. It's 2023. I mean, we've all made more money doing it the, you know, 80-20 way versus the, you know, preferred return and all that, because we probably would have been pushing to sell it, you know, after owning it for 5 years, because values went up so much by 2013, but then we would have lost out on the last 10 years of profit on that deal. So
Interesting. I like it, Drew. And do you get to sign on any of these loans to like build up your own personal um, balance sheet?
yeah, I've signed on every loan on every deal. That's it's Yeah, that was a requirement, you know, in order to sort of, we're in, also it was 20% of the profits, but also 20% of the losses if it would have lost money. So it was, you know, we're standing shoulder to shoulder on every aspect of it, the loan guarantees, the profits, the losses. It's just the roles where they put in the money, we do the work, is so.
Awesome, man. And so over the past few years, are you do you have a team? Are you working alone? And you mentioned you were syndicating a bit more. So what does life look like now?
Yeah, 2021, I made a pretty big pivot in terms of what we're doing, where until then it was really just me finding every deal, doing every deal. We had you know, help with accounting and property management and other things, maintenance, obviously. But, you know, it was just me doing every deal. And in 2021, I hired 3 acquisitions people. And then we wanted to make a pivot and focus on the Sun Belt, where on average, the deals we sold, our returns, it's a 25% realized IRR. But I feel like in the Sun Belt, you could have probably bought almost anything in Phoenix and in Dallas or Austin and Florida, and really crushed it and made those similar kind of returns. So we were able to do it in the Midwest. And then at some point along the way, let's see, 2012, I moved to Chicago. And then most of the deals we bought from 2012 to 2021 were in Chicago. And all those deals went well, where there's the same profile, value add, but more operational value add, buy it on the low rents, raise the rents, and then do a cash out refinance with the Freddie SBL program. I've done about 30 agency loans, just a really great program. And on average, we pulled out more than 100% of the equity we put down on each of those deals. That's how we were able to take, because one thing, yeah, buying, you know, $200 million of property, it wasn't like those people put, you know, whatever, 80 million down or 50 million down. It was more where we started out with a few deals, and then we would refinance out money or sell one and then buy bigger ones. So it was building it slowly as well. So I haven't but in terms of today, yeah, we're focusing on the Sun Belt, so Phoenix, Dallas, and Austin, multifamily only. So Phoenix is a great market. That's had some of the highest rent growth the last 20 years, and especially in recent years in the whole country, as well as Austin. That's number 1 for population and job growth. Dallas is very, very stable, as well as a Sun Belt growth market. So it's those 3 work really well together. Arizona has the most favorable property tax laws in the entire country. It has a 5% per year assessed value cap. So you have a lot of tax certainty there. And then also insurance is really attractive because there's no natural disasters really there. It's just hot. There's no tornadoes or hurricanes or anything to really worry about. So insurance is low, and as are taxes. So Phoenix is our favorite market. And then from there, we're big fans of Texas, and they're trying to get in a big way.
Cool, man. Yeah, insurance is kicking our butt down in Florida. It essentially doubled over the past 6 months or so, and it is what it is. But hopefully things will change. And if not, look, we're still cash flowing, we're still doing well, because we're able to push rents, right? So that there is some forgiveness there. Now, you mentioned that you know the Freddie SBL. Do you have any floating rate loans right now? And have you seen any people struggling with that?
I've seen a lot of people struggling with those. Yeah, we have one only. So yeah, out of 29 or 30 properties. Yeah, we have one where it was a large renovation project, and so there wasn't really any fixed rate options available for that. But no, we've always done fixed rate. It's interesting. I know a lender who's in Los Angeles, and he primarily lends in the Sun Belt, and he's almost never done a fixed rate loan. Whereas my guys in the Midwest, they've almost never done a floating rate loan. So it's almost like a cultural difference with the coast and the Midwest, where there's not a lot of floating rate borrowers in the Midwest. And I just kind of applied that to the Phoenix deals I bought, where 4 out of the 5 were floating rate, bank loans. So in our floating rate one we have, I guess if people are curious, we bought an interest rate cap at the start of that. So we haven't gotten smoked with that at all. Like we fortunately we picked a relatively low strike, and we downloaded the SOFR curve at the time in our model, and it's it's sort of actually gone pretty close to how we thought. And from the interest rate standpoint, rents have softened, and obviously values have with interest rates going up. So that wasn't predicted, but we were spot on with construction and the interest rates, which at the time I thought those were probably the biggest wild cards. So
Very interesting, Drew. Thank you so much, man. So how often do you download that SOFR curve to your spreadsheet? Is it every deal, or do you update it?
Yeah, well, not often these days. We're not doing any fixed rate stuff with how high the rates are. If you're looking at multifamily, let's say deals that are over 5 million of loan amount, almost everybody is just doing Freddie and Fannie loans. So and they do have a floating rate program, and so a lot of people are still doing that, but we're only looking at the 5-year fixed options. And then just depending on what kind of deal it is, then we'll pick a different prepay. On a longer term hold, maybe we'll opt for the lower rate and do yield maintenance versus the step down. So.
And what are rates like, today? I know you're not a loan guy, but it sounds like you're doing a lot of loans. So how are we looking today if you wanted to buy something like your standard typical acquisition? What would it look like?
Yeah, depends on the deal size, and but I think if we're talking a plus or minus a $10 million deal, and this is one thing that is so great about multifamily. If you went to a bank today, it's hard to get a loan, and your quotes are going to range from anywhere from 6% to 9% on that deal. But that's why everyone's going to the agencies, and that's a huge advantage multifamily has that the other asset classes do not have. So other asset classes, meaning like office or retail or industrial. And so rates on those kind of loans are, in the mid fives, so 5.5%, maybe on up to 6%. And then with a Freddie SBL program, that's a streamlined program through the agencies for loans from 1 to 5 or 7.5 million, depending on the market. And then they size that to a 120 or 125 debt cover, depending on the market. 80% max LTV. Those rates are a little higher, and they have discounts for depending on how good of a market you're in. The better the market, the more they'll push the rate. But those are a little higher, so call it plus or minus 6%. So
awesome, man. Yeah, I was just quoted for that for the Freddie SBL on a smaller deal. It was a 3 million, and they were going to do 80 LTV. I didn't win the deal though, but because it sized pretty well.
Yeah, where was that deal geographically?
It was in Florida, in Bradenton.
Oh, nice. Yeah, that's a great market, and that's a really high LTV for there. I would have thought it would have been limited by that debt service coverage before getting to 80%.
They were getting that 125, man. So they went
nice.
For it. So I didn't get it though. But anyway, Drew, I got to wrap it up pretty soon because I have another call. But I don't want to cut you off without you sharing anything important that I missed throughout this call.
Yeah, I think that covers it. I think kind of just in terms of maybe anything else we didn't really cover on. I think a big advantage and something maybe that for anyone who's starting out is really like, don't be afraid to ask questions. I think that's been something that's been a huge advantage for me, is I've always been curious, and because I didn't come from money or have any sort of background really, I've just always asked people, how does that work, or observed others. So that's a tip if you're whether you're new or experienced. And if you want to see more, I have a podcast, the Breneman Blueprint. People could check that out if they want to learn more about real estate. And then as well as like our company, we've been talking about it, it's Breneman Capital. And so our website is breneman.com for that, B as in boy, RENEMAN. And you can sign up to be an investor if you like the idea of passive investing, just throwing money into deals and not having to sign in the loans or deal with any of the headaches. You can sign up there. And then we have a passive investing download. It's a guidebook, teaches you all about passive investing. That's on the website in the download section. And then I'm on social media too, at Drew Breneman in most places. So I think that's if people want to learn more, just best to pick whatever you're into from there and get after it. So
awesome, Drew. Thank you so much. Hey, let's I can't leave, without getting this last question in too. So let's imagine it was 100 years from now. You have heirs running around or great grandchildren and they're happy and they want to write a book about you. What would you want them to title this book?
I think the title would be, I'm really glad that my grandpa bought all those apartment deals.
I like it, man. Simple and cool and fun. I love it.
Yeah.
Cool.
So no, that's what they'll be saying. I got a 5-year-old now, and he's funny. I found something he's interested in with these. He actually likes seeing all the problems, where he'll go on the website or somewhere and ask me what happened at this building, and I'll be like, oh, the sewer broke at that one, or that one that we had a fire, because he likes to see the problems. And so he's gone to a lot of the buildings. If he's interested, if I'm going to look at issues, if I'm just touring, there's no problems to look at, he's not that interested. So
that's cool, man. I have a 7-year-old, and I finally got her down to Florida to look at our properties, and she was like in awe. She was like, wait, we own these? I was like, yeah, we own them. And she was walking through the units and stuff. She had a lot of fun. So it's a great thing, I guess, to share with our kids.
Yeah, got to find something they're interested in. We were going around, he was just kind of tagging along and was not interested at all. And then one of them, I was like, yeah, we're having an issue in the parking lot here. So it looks like it might need to be replaced, or was like kind of breaking. And he like hopped out the car and was like, let's check it out. And that was the first, and that was, otherwise I was, dragging him out every time, like, let's go. So then he's, ready to go. And he's seen roof replacements and everything now at this point. So.
Wow. Great job, man. You're doing a great job as a dad. All right, Drew. Well, it has been a wonderful time talking to you today. I really did learn a lot from you, and you're a super smart, intelligent, well-versed guy. I'm excited to continue, our relationship and talking in the future. And if anybody wants to reach out to you, please, I urge you to do so, because Drew is up to some big things, and he's just a great guy to talk to. So thank you for joining me again today.
Thanks for having me. Appreciate it.
All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast, where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.